Good day, everyone. I'm the last reporter of Group 6, and I will be tackling about the global financial crisis of 2008. First, we will tackle about the origin of the crisis. The crisis begins from the late 90s to about 2006, U.S. home prices rose rapidly, driven by the low interest rate, easy credit, and strong demand. The growth created a speculative bubbles. Many buyers purchase home expecting prices to keep climbing. When the prices at peak and then begin to fall around 2006 to 2007, homeowners who had borrowed a high loan to the value ratio lost equity. Then falling prices means that they could not refinance or sell to escape rising payments, and many became unable to meet mortgage obligation as default rose. The housing market stopped supporting the financial product built on, starting the change of a failure. Next is the cost of excessive risk taking by a global financial institution. Banks, investment banks, huge funds, and other financial firms increased leverage and took concentrated position in the mortgage-related assets to boost the profit. They underwrote, bought, and financed large quantities of mortgage-backed product without fully pricing the downside risk. Many firms relied on short-term wholesale funding and repo markets. Next is the bank issue subprime mortgage and bundles them into risky securities. Then this means that lenders lose standards, offering loans to the borrowers with a risk credit, variable rate terms, limited documentation, or high loans to value ratio. Rather than securitizer, investment banks slice those pools into tranches with different risk and return policies. Rating engines risk and ratings return policy. Next is the Lehman Brothers failure lead to the global panic and market collapse. The Lehman Brothers, a major investment bank with large exposure to mortgage securities and fundings brought through short-term market, failed by the bankruptcy on September 15, 2008. It suddenly collapsed, removed a key counterparty, and destroyed confidence in the pricing and safety of many financial assets. Money market froze as institutions became unwilling to lead. Even overnight interbank borrowing rates spiked and liquidity evaporated. The failure signaled that even large sophisticated firms would fail, promoting massive market sell-off, credit contractions, and immediate runs on the valuable institution. The next is the resulted in widespread bank failure, job losses, and economic recession. This this is the result when a bank crisis began as a value assets plug and the funding dried up. Numerous banks and non-bank financial firms required financial support, government bailout, or a restructuring. Lending to the house and businesses contracted sharply, reducing investment and consumption. Firms cut production and laid off workers. Global unemployment rose and economic output contracted. The United States and many other economies entered with a deep recessions in 2008 to 2009, with severe social effect and long-lasting fiscal consequences as a government increased spending to stabilize financial system and stimulate growth. The next one we will tackle is the monetary policy response about the global financial crisis. First, they respond zero interest rate policy. In response to the financial turmoil, central bank, particularly the U.S. Federal Reserve, rapidly cut their policy interest rate to almost 0%. This is known as the zero interest rate policy. The goal was to make borrower cheaper for a business and consumer, encourage spending and investment, and prevent the economy to sliding deeper into the recession. When the interests are low, people are more likely to take loans out for homes, cars, and businesses expansion, helping to stimulate economic growth. Many central banks around the world follows this strategy, including the European Central Bank and Bank of England. Lastly is the Bank of Japan. Next, they respond the quantitative easing. Once interest rate reach zero, traditional monetary policy tools are no longer effective. To further support their economy, the central bank introduced quantitative easing, a form of unconventional monetary policy. Under QE, or the quantitative easing, the central bank purchased large quantity of long-term government bonds and mortgage-backed security from financial institutions. It has several effects. First is the increased money supply in the economy. Second is it lowers long-term interest rate. And lastly, it boosts confidence by showing the government's strong commitment to the stabilizing financial system. The next one to the response is the emergency liquidity program. To prevent the collapse major financial institutions and store trust in credit markets, central bank created a special lending program to supply emergency funds to the bank investment firm. First is the terms action facilities. The term action facilities was introduced by the Federal Reserve in December 2007. It allowed banks to borrow short-term funds directly from the central bank using a competitive action system. Next is the primary dealer credit facilities. The primary dealer credit facility was created on March 2008. It allowed the Federal Reserve to lend directly to the major investment firms called primary dealer, which were not traditional banks but played a key role to the financial market. The primary dealers credit facilities help these firms maintain access to cash when normal funding source had dried up. The last one that